we are going to the section 6 now, analysis and interpretation. There are two notes that I prepared for the analysis and interpretation. First one is a 6.1 calculation and understanding the accounting ratio. Basically, this notes is more toward formula that you need to memorize. This is all these have the formula which you need to practice and memorize on it. Okay, another section is interpreting the accounting ratio. From the accounting ratio that you are gathered, so you need to make comment, recommendation, or solution in order to improve the situation. So we will use the question to practice this section. Okay, profitability ratio. What is the profitability ratio? Accounting, in the previous chapter, most of it is given you the number and you need to prepare according to the format or the standard of the accounting format. And come to this topic, we will convert the number into the ratio for comparison so that we can see for those that without the accounting knowledge, they can still use the data to analyze the business performance. That is the purpose of the ratio. So what's the profitability ratio? Profitability ratio basically is that to check whether your business performance, okay, whether you are making profit or you're making a losses using the financial statement that you learn. For example, income statement, statement of financial position. So for gross profit, profit margin, you can use it for, can learn it, can get it from your income statement. Return on capital employed, basically you need to combine using the profit and also the statement of financial position. For the formula, we will go to next. Okay. Okay, formula. Gross profit margin, or sometimes we just say gross margin. Gross profit margin is a gross profit over the revenue times 100%. Whereas sometimes the question will give us the markup. Markup is the gross profit over the cost of sales. So in our income statement that we are preparing in the past, we will always start with the revenue minus cost of sales. And then this cost of sales, we get the gross profit. So when we say the gross margin or gross profit margin means that our revenue is base, which is 100%. This is the X percentage of the 100%. Whereas when we have the markup, which is that the base will be the cost of sales, and here is the percentage according to the question. So that means that in order to find the revenue percentage, we will take the 100% plus the X percentage in here. Whereas to find using the gross margin or gross profit margin, we take the 100 minus the X. 100 minus the X, that will be the cost of sales. Okay, next, gross margin, profit margin. Profit margin is after we minus the expenses, then we get the profit. So profit margin is the profit, this profit, divide by the revenue times 100%. Return on capital employed, which is sometimes we call ROCE, which is a net profit before the interest. Before the interest means that don't include the bank interest, loan interest, or the debenture interest. This is called the before the interest. So when the question have given us the profit for the year, so you can plus the interest that you get. That will be your net profit before the interest over the capital employed. Capital employed basically is this one is a company account. So if not, you will have a capital plus the current, okay, plus the current liability. Each one issue share and plus reserve. This is under the company, limited company topic. You will use the issue share plus the reserve. Okay. Profitability ratio. What is the factor that for the reduction of the gross profit. A rise in the price of the goods purchased may not have been passed on the customer. Means that when the purchase price increase, cost of sales increase. When cost of sales increase, gross profit will be decreased. So this cost cannot pass to the customer. That means the gross profit will be reduced. There is a deduction. It may have been necessary to purchase the goods from the different supplier at a higher price. This is happened for the manufacturing. If the capacity is full, they have to buy from the outsider for higher price in order to supply to the customer. The cost of sales may have been increased by the theft of the stock. That means some internal control is not good. That someone is steal the goods for personal or took out without the knowing from the management. Okay. The margin on sales may have been cut. What is the margin on sales? That means this one is a gross profit over sales or revenue times the 100%. So this one had to reduce. Okay, this amount had to reduce because this one reduced or this one has. Okay, now next to increase the volume of the sales. So in order to increase the volume of the sales, we reduce the selling price. Even though the quantity increased, sometimes the selling price decrease percentage more than the quantity increase. So therefore the margin will decrease. To fight competition from other business, sometimes have more competition, that we have no choice, we have to reduce the selling price. And an introduction of offer for the new product. When new product launching, we want to attract a new customer coming to buy from us, so we reduce the price of it. As a result of the seasonal sales, for the seasonal sales, especially when it's a winter, okay, so that those that other clothes not for winter wear, it will reduce the price in order to get rid of the old season. To dispose of out of date or damaged stock. This is happen especially for the seasonal sales. To increase cash flow when the business is short of cash. So in order to get cash coming in, we just reduce the price to make sure people pay us first. All the questions that I'm showing just now, the two theory, basically it will appear in the theory question. They will give you the scenario of the calculation. After that, they give you the comment or give you the reason, give the reason why caused the situation. Next, how to improve the business profit. To increase the revenue, one of the way is increase the selling price. But this selling price must make sure that your goods is essential goods so that people must buy from you even though the price is increased. Reduce the cost, reduce the purchase price by searching cheaper supplier. Try to get the cheaper supplier so that the cost of sales will reduce. Reduce the wastage, better control. Don't waste during the production process, then it will reduce the cost of sales and increase the profit. Improve the control of inventory by reducing the storage costs. When we do the control on the inventory production, so we reduce the storage cost and at the same time we reduce the outdated stock. Inventory reorder level, which is that you have a powerful inventory control system which is able to integrate from different departments to ensure the supply of the goods are able to fulfill the requirement from the customer. We just keep a minimum stock level. Okay. Liquidity ratio. Liquidity is talking about the real cash money that can use to pay the short-term debt. So liquidity measure the ability of the business to turn asset into cash to pay its short-term debt. What is the formula for this topic? Current ratio, liquid ratio, or sometimes acid test, rate of inventory turnover, trade receivable turnover, trade payable turnover. Okay, next, move on. Measure the ability business to turn asset into cash to pay its short-term debt. There is a liquidity ratio. So the formula, the first formula, current ratio, sometimes we call working capital ratio, which is a current asset to the current ratio. That means the answer must be left and right in the ratio format. And the behind current ratio always must be 1. This one will be depend on the question, X value that you will get. So if you want to calculate current ratio, basically it's a current asset over the current liability. Next is liquid asset test ratio, which is current asset minus. So this one minus the inventory means that we do not include the inventory in our ratio, which is we take the current asset but not include the inventory over the liability, the current liability. Current ratio versus the liquid ratio. Why we have 2 ratios to measure the ability of the business to pay off the short-term debt? Which one is better? Basically, liquid ratio is better than the current ratio to measure the liquidity. Quick ratio is more accurate measure of the liquidity than the current ratio, working capital ratio, because the inventory may be difficult or take a longer time to sell. Inventory may deteriorate or become obsolete so that this value become useless. Inventory is 2 stages away from the cash. Why is 2 stages away from the cash? Means that we sell to the customer, after that only we get the cash. So that is called 2 stage. Trade receivable is 1 stage away from the cash, whereas trade receivable is only 1 stage, because here from this inventory, we go to trade receivable, go to the cash, and then trade receivable is go to the cash, turn to the cash. Only liquid assets are included. So that is the reason why liquid ratio is better option for the current ratio to measure the liquidity. What is the way that we can use to increase our current ratio? Introduce the additional capital. When the additional capital increase, bank will increase. Reduce the drawing. When you reduce the drawing, the money in the bank will increase. Bank will increase. Okay, next, obtain the long-term loan means that debit bank, credit the non-current liability. Loan is a non-current liability. Sell surplus non-current asset means that debit current asset we get, which is basically is the bank, and credit non-current asset. So this one will increase. Disadvantage of having insufficient working capital. Working capital is a current asset minus current liability. Okay, that is called working capital. What was problem that we will have? Cannot meet liability when they are due. Experience difficulty in obtain further supply on the credit, especially from the trade payable, the supplier. Cannot take advantage of the cash discount. That means you cannot receive the cash discount, which is this cash discount is we call discount received. Discount received. Cannot take advantage of the business opportunity as they arise. That means when you have a new business opportunity, you got no money to do the investment. Next is that the way we could reduce or eliminate the bank overdraft. Bank overdraft is a current liability. How we want to reduce it? Collect receivable means trade receivable, collect from your customer money, reduce the inventory, don't hold it or try to sell off it so that you can get the cash and then put into the bank. Delay payment of the payable means that you delay the payment, then after that you can keep the cash in the bank so that your bank overdraft will reduce. But disadvantage of the delay payment of the payable, your customer, your supplier may stop supply to you. Sell extra non-current asset means that you turn your non-current asset, unused non-current asset into the cash. Okay. Rate of inventory turnover, which is the answer must be in time. The formula is the cost of sales, cost of goods sold or cost of sales over the average inventory. So what is the rate of inventory turnover? It indicate how quickly the inventory can be sold. So, for example, how many times that you sell, more will be better, because if you have 20 times compared to 15 times, you mean your stock turnaround is 20 times, which is faster compared to 15 times. So this one will be better. So more time is better. Okay. The way could improve the rate of inventory turnover. Reduce inventory level by reduce the purchases. Give discount to get rid of the surplus stock. Generate more sales activity. Like example, do the promotion, advertisement. Promote sales by offering cash or trade discount so that you can get the cash instead of keep the stock. Reduce selling price to sell more. Reduce markup on the cost of the sales. That means basically sell cheaper. These two basically sell cheaper, the stock will reduce. Find cheaper supplier, buy in bulk to reduce the cost of sales, because the formula is cost of sales over the average inventory. Only replace inventory when needed. Use a just-in-time stock control system. This one just-in-time stock is a control system for the inventory, which is integrated with different departments. This is only for the big organization that will do it. Okay, next. Disadvantage of holding too much inventory. When we hold too much inventory, what is the problem? The stock becomes obsolete. Obsolete means that outdated, cannot be sold. Holding cost of storage cost increase, the rental increase. Space occupied by storage, that means you don't have space to do other things. Deterioration or damage of the inventory, basically is this one similar. Once it's obsolete or damaged, you cannot sell. Reach of the theft, that means your internal or outsider may come and steal your inventory. Liquidity problem, that means you lack of the cash. Short of the cash, that means you don't have the money to pay off the short of cash. So you don't have the money to pay off your other expenses. Okay. Trade receivable turnover. Trade receivable turnover is that trade receivable over the credit sales times 365 days. And take note that always when you get the answer in decimal, let's say you get 26.7, okay, day, you must round up to 27 days. If you have 26.4, you must also round up to 27 days. That is something that you need to take note about trade receivable. This is to show that, for example, basically your customer average take 27 days to pay you, or you collect your customer money within or average 27 days. Okay. The way which could improve the collection period for the trade receivable: offer cash discount, which is the discount allowed for the prompt payment, charge interest on the overdue account, improve credit control, refuse further supply on credit until outstanding balance paid, invoice discounting. Invoice discounting means that you sell your invoice to the bank will give you the money, but with the discounted price. Like normally this one be the LC, letter of credit from the overseas. And debt factoring, basically you get somebody to help you to collect the debt. Or you sell your debt also can. Okay, trade payable turnover. Trade payable over the credit purchases times 365 days. Same thing must be always is next whole day. Okay, this is to showing that, let's say example, you have 30 days, you have 25 days. This one basically is taking 30 days to pay the supplier. This one basically take 25 days to pay the supplier. There is a pro and con, pay faster and the later, depending on the situation and the question. Okay, relationship of the gross profit and the profit for the year to the valuation of inventory, rate of inventory turnover, revenue, expenses, and the equity. So here, this is something that I would like to highlight, that most of the time in the exam, they will use this information. Let's say example in the question, they ask you to prepare the income statement or they give you some information about the gross margin or markup. Take note that gross margin, the formula is that gross profit over revenue times 100%. Whereas markup is the gross profit over cost of sales times 100%. So the number that appear in here, revenue, will be 100%. Same to this one, cost is on the bottom. This one is 100%. So to find any pair of the information here, gross profit is given by the question. To find the cost of sales, you just take 100 minus the gross profit margin. So this one, whereas to find the revenue, we have to plus the gross profit margin. Okay, next. Okay, so this is the slide that I prepared for the 6.1 and 6.2 for the interpretation and the analysis topic.